People, listen to me. If you are standing on the precipice of retirement, or if you have already crossed that finish line, you are likely feeling a heavy, underlying weight. It is the fear of the unknown. You look at your hard-earned nest egg, the 401k, the traditional IRA, the Roth accounts you sacrificed for decades to build, and a terrifying question creeps into your mind late at night: am I going to run out of money before I run out of breath? They make it sound so easy, so alluring, so incredibly liberating. They tell you that you can safely take 7% out of your retirement portfolio every single year, pay your taxes, live like a king or queen in your golden years, and never have to worry. But I need you to wake up and look me in the eyes right now. Because what no one is telling you is that blindly following an unverified, aggressive rule like this is one of the fastest ways to put your financial security in severe jeopardy. It is a trap born out of optimism and fueled by a massive misunderstanding of how sequence of returns and taxes actually intersect in the real world. Let's break down exactly what this concept is and where the danger lies. Traditionally, for 30 years, the gold standard has been the 4% rule. It was based on historical market data showing that if you withdrew 4% in your first year of retirement and adjusted that dollar amount for inflation every year after, your money was virtually guaranteed to last for 30 years. But over the last few years, people look at the recent booming stock market and they get greedy. They get confident. They say, the market has been up 9% or 10% above inflation, so why should I restrict myself to a measly 4%? I want to travel now. I want to buy the RV now while my health is good. I'm going to use the 7% rule. On paper, the math smiles at you. If you have a $1 million nest egg, the 4% rule gives you $40,000 a year. But the 7% rule gives you $70,000 a year. That is a massive difference in your quality of life. You think, hey, if my investments grow by an average of 7% a year, and I take out 7% a year, my principal stays exactly the same, right? Wrong. Dead wrong. And this is the fundamental mistake that will ruin your retirement if you aren't careful. The market does not move in a straight line. It fluctuates. And when you are withdrawing an aggressive 7% from your portfolio, you are exposing yourself to a catastrophic financial phantom known as sequence of returns risk. Imagine you retire, you enthusiastically apply the 7% rule, and in your very first year, the stock market hits a brutal downturn and drops 15%. If you were still working, a down market wouldn't matter because you wouldn't be selling your shares. But now you are retired. You need that $70,000 to live. So what do? You are forced to sell your mutual funds and stocks when they are down at rock bottom prices just to get your cash. You are locking in those losses permanently. Now your $1 million portfolio isn't just down from the market drop, it is severely depleted by your massive 7% withdrawal. When the market eventually recovers, and it always recovers, you have far fewer shares left in your account to participate in the upside. Your nest egg has been fundamentally broken. Financial simulations show that under average market conditions, a 7% withdrawal rate might stretch to 15 or 20 years. But if you hit a bad market downturn early in your retirement, your money could be completely wiped out in as little as 10 to 12 years. 12 years. What are you going to do if you hit age 75 or 80 and your accounts read zero? You cannot afford to take that gamble. When people online talk about the 7% rule for tax retirement, they often gloss over the reality of how that money is taxed. If the vast majority of your savings is tied up in tax-deferred accounts like a traditional 401k or a traditional IRA, that $70,000 you withdraw isn't yours to keep. Every single dollar of it is taxed as ordinary income. If you need $70,000 in cash to cover your bills, your travel, and your lifestyle, you actually have to withdraw significantly more than 7% from your account just to pay the federal and state income taxes. Suddenly, your 7% withdrawal rate balloons into an 8.5% or 9% effective withdrawal rate. You are systematically cannibalizing your own retirement fund at a speed that guarantees disaster. So, what is the answer? How do you answer the question of how much you can safely spend without falling into this trap? You must move away from rigid, static percentages and embrace a dynamic, protective strategy. If you want to enjoy your early retirement years and spend a bit more while you are active, you cannot just blindly pull a flat 7% every year regardless of what the market is doing. You have to implement what we call financial guardrails. A guardrail approach means you establish a baseline withdrawal, say 5%, but you agree to be flexible. If the market has a fabulous, booming year, you can give yourself a little bonus and withdraw a bit more to fund that extra vacation. But if the market takes a dive, you must have the discipline to scale back your spending, cut the discretionary fat, and lower your withdrawal rate to protect your principal while prices are low. Furthermore, you must proactively manage your tax brackets before you start pulling massive sums out. If you are approaching retirement or newly retired, look into a systematic Roth conversion strategy. Convert a portion of your traditional IRA funds into a Roth IRA during years when your income is lower. Yes, you will pay the tax upfront today, but that money will then grow tax-free, and when you withdraw it later in retirement, it comes out completely tax-free. This allows you to control your tax bracket and prevents Uncle Sam from forcing you into a higher tax tier when your required minimum distributions kick in later. Listen to me, your retirement is not a game of chance. You work too hard, you save too long, and you sacrifice too much to let an arbitrary, aggressive rule of thumb dictate your financial destiny. True financial freedom doesn't come from taking high-stakes gambles with your nest egg just to get a bigger check today. It comes from clarity, it comes from protection, and it comes from building a dynamic plan that can weather any economic storm. Be smart with your money, be honest with your spending, and you will create a retirement that is safe, secure, and permanent.